Alright guys, welcome to the new video. In this video we will be predicting the Alphabet share price. Of course you have to note that this is only the prediction. The stock market risk is sometimes called uncontrollable risk because there are so many factors that comes into play and you cannot really control everything and build a model that will be counting everything and predicting the stock price, but we can make so-called the best guess based on company's financials, and then we dive to technical analysis. We'll see where the stock is trading, and also based on stock's financials, fundamentals, we will try to predict how strong the stock is and whether it has strong midterm support or no. So let us start. We will be using the financial modeling prep API endpoints and Google Sheet to extract important financial data that will help us with our fundamental analysis. Well, first of all, you need to open the Google Sheet, open the financial modeling prep add-on. I will send you the link explaining how you can do that, but then inside the extensions there will be add-ons. You have to search the financial modeling prep, and after finding it you will have something like this, financial modeling prep. Then you have to get your custom API key. Once you register with financial modeling prep, you get your custom API key that you can use. Down to this video I'll put the detailed instructions, a guide on how you can get this installed and use the financial modeling prep. So after installing financial modeling prep and opening the Google Sheets, you should just use the formula for extracting the data. The first thing we will be extracting is the price target consensus to see what investment analysts are thinking about the target price. So consensus target price is the average price that analysts are calculated for, in our case, for Alphabet share. The formula is straightforward, equals FMP price target consensus. So it's over here. Once you connect your API key, you can input this formula, and then A2 is referencing this ticker. We will replace it shortly, but first let me explain the formulas. FMP price target consensus A2, so it's referencing this formula A2. The next thing we're going to be using is the price FMP price targets to see what are their price targets. We are interested in 5 most recent price targets. As you can see, there are different investment analysts and their names who are putting the target price. You can see the adjusted target price, that's the calculations, and you can see the date and you can see the stock price when it's posted. Also, you can see the analyst company. We'll not be taking all the prices because some of them are not relevant anymore. That's why we're taking 5 the most recent prices. Then we see the average target price. This would be more accurate than this one. So let us replace with the Google ticker, GOOGL, Google. And as you can see, it already started calculating everything, extracting the data. Now we just have to wait. Yeah, we see the target high. Someone put 225, one analyst put 170, and the average price target between different analysts is 201. So the median price is 215 and the consensus average price 201.64. Now you can see what our different investment analysts are putting. By the way, the formula for the target prices for all target prices is FMP price target A2. Again, it's referencing this ticker. And we can see the dates of the publishing. As you can see, that it was not updated recently, so the only one most current update is November, and the adjusted target price was 200, which is plus minus close to our target consensus for Google. And now we can compare it to the market price. If the target price is higher than the market price, the stock is undervalued. If the target price is lower than the current market price, the stock is overvalued. And if it's equals, plus minus equal to the target price, I mean if the market price is equals to the target price, the share is fairly valued. Then I have this WACC ROIC. As you can see, it's a B11. It's extracted from here. The formula is FMP Advanced DCF, and then I take A2 and A4. As you can see, A2 is the Google and A4 is just a name. So the financial modeling prep sees this name and it extracts from the table. So if you don't put this name, it will extract you a lot of data, but we don't need those data from advanced DCF model that FMP financial modeling prep provides. In this case, we only need WACC. That's why I am putting the ticker and then what we need to extract, and it extracted as the weighted average cost of capital. In simple terms, it's the average cost the company has from its equity and from attracting its debt. That is the bonds, bank credit, you name it. And this is the average cost for Google shares. For Alphabet is 8.95. Then we need to extract the ROIC trailing 12 months. The ROIC goes from C11, you can see the C11, and the formula is FMP key metrics TTM. TTM stands for trailing 12 months. And then again A2, this one we miss, limit and period, we don't need it, and header is A5, which is the name of the parameter that we need to extract. In our case, it's ROIC trailing 12 months. So ROIC is the return on the attracted capital the company generated. So the company attracted money through equity, through debt, through bonds, and then it was investing this money and got this 25% return, which is higher than the weighted average cost of capital, and it exceeded by 2.88 coefficient, which is a very good sign. And what you can do, you can take Google's closest peers. We'll do it a bit later in this video, and then compare it and choose the stock with the highest ROIC to WACC ratio. It will tell you about the capital efficiency. So if the company has higher ratio, it is utilizing its assets, its attracted funds, more efficiently. So this picture is kind of giving us more or less accurate, better picture of the Google shares. Now let's dive into the basic valuation. It's a price income model. I can put the link to the article where I explain how to calculate the stock target price. As you know, there are three valuation models. It's a discounted cash flow, dividend discount model, and the price income, or sometimes some analysts call them multipliers model. That is, you take companies' financial ratios, compare them to peers, ideally also compare them to developed and developing countries, calculate the coefficient, and then multiply it by stock current price. So in this case, let me replace the symbol. The formula is FMP real-time price. A4, it is the stock ticker again. This is the 4, this is A. This is the stock ticker that we need to replace. Simply, we put here the Google ticker, hit enter, and now it is calculating the current price. As you can see, the current price is 184, but the target price was 201, so the stock is currently undervalued and it has some growth potential. We can of course calculate the growth potential if you want. From here we know that the stock target price is 201 and the current market price is 184. So based on consensus target price, the stock has 8.83% growth potential and looks undervalued. Then I take important company ratios. Again, I'm using financial modeling prep, and the formula here is FMP key metrics TTM, again trailing 12 months, FMP key metrics TTM L4, and L4 is the stock ticker over here. I'm taking the Google share, and here they're the closest company peers, so closest Google peers that we need to take. Let me show you another API endpoint for choosing the closest company peers. So for example, for Google share, let me go to financial modeling prep website. And in financial modeling prep, go API documentation. And here in the search, just type peers, stock peers over here. And then after obtaining your custom API key, you will be able to use this API endpoint. Here it is, stock peers. Just open it, you see the Apple here, and then in address bar, you should change the Apple to Google. And you will be good to go. So now we have Google's closest peers. Let's take them from here. and paste them to our model. So you see it is already recalculating, extracting the ratios. Let's put 3 more. And let's put this one. And this one. So now what we did, we extracted important financial ratios. As you can see, it's a cash per share, it's operating cash flow per share. This is the book value per share, different financial ratios. And I took 10 that I consider very important ratios. Of course, you can take different financial ratios as you see fit. And based on these 10 ratios, these are the ratios for the Google company. And as you can see, the formula, for example, AC6, and it goes here, AC6, enterprise value to sales trailing 12 months. It is 638. And then we compare it to the industry average, to the closest peers. As you can see from here, I'm taking the same enterprise value to sales trailing 12 months, but this time I'm just taking average among 4 closest peers, and then I hit go, and then I see the average ratio, and then we compare the ratio. The last thing, I assign the weight to different ratios. Since we have 10 ratios, each of these ratios will be assigned at 10%, and some they will be 100% or 1. Then we calculate the weights. This is the simple formula, the ratio of the company divided by the ratio of the average, and multiplied by the weight that we have here. Again, I have a detailed article on how to use this model, and I will put the reference down to this video so that you can read and understand what this model is all about. Then we have a current share price. Then we have a coefficient. It's a sum of all the individual coefficients that we calculated from ratios. And then we have a stock target price, which is basically the current market price multiplied by this coefficient, which implies 15% growth potential based on the price income model, or some analysts call it ratios model. So the stock has 15.82, almost 16% growth potential, and based on consensus target price, the stock has 8% growth potential. So now the next thing what we can do, I already replaced here Google, the stock ticker. That's my another model. So basically I'm seeing, is Google the worst buying? So here I extract the result of the EPS growth rate. As you can see, the formula is FMP, historical earnings calendar. Then I take B2 and 50. So it's just a number of observations. If you have questions, you can see it here. If I don't put the limit, it will extract a lot of data, but we don't need a lot of data. We just need the recent quarters, recent readings. Seeing its EPS growth over the past year, I'm taking the EPS data for the past 5 years and then comparing the growth rate. So the EPS growth rate, earnings per share growth rate, is generally should be above 15. It's a good number. So as you know, the earnings per share, it's a net income divided by the shares outstanding. So if it's above 15% over the past 5 years, it's good. It tells us about the profitability of the company. So let's calculate for Google share. This is the recent EPS of the Google, and let's take F60. As you can see, it's even higher, starting from the 2013, but we can take, let's say, 2020 if we want to. That's the year 2020. Let's take from there. Yeah, let's take F34. F34. 179%. So starting from the year 2020, as over here, starting from the year 2020, EPS growth rate for the Google share, for the Alphabet share, was 179.22%, which is amazing result. Then beta in market cap we extract a little bit later. Price to earnings ratio, it's 22, but since we already calculated the stock target price using the price income model, it's a more or less good ratio. It's in line with the industry average. And since we calculated using the price, the stock target price using the price income model, and we see the 15% gross potential, then don't put too much attention to this ratio. But normally, if this ratio is higher than the industry average, it tells us about it tells us whether the company is undervalued or overvalued. But in our case, we saw that the company is undervalued with a 15% gross potential. So don't put attention to this a lot. And then we have a PEG ratio. I placed the formula here. It's a price earnings ratio divided by earnings per share growth rate. It is 12. Ideally, it should be below 1. It tells us about the company that it still has amazing growth potential and the company is undervalued based on this ratio. But in our case, we have a 12 here. It is higher than 1. It means that the company is overvalued based on this ratio. But please don't consider only this ratio alone. Consider multiple ratios as we did in our model. Since we already took a lot of ratios, a lot of 10 ratios in our price income model, we're also not putting attention to this. But let's say under some reason you're not using this model for equity valuation, for calculating the stock target price, you only want to use this model like a PEG ratio and price to earnings. Then based on the PEG ratio, the company is overvalued. But in our case, it has 15% gross potential based on the price income model. So as you can see, this is the EPS data, revenue estimate, and revenue actual. You can also compare this data and EPS estimate, EPS actual to see if the company was beating the estimates. If the Google was beating the estimates for the past 4 quarters, that's a good sign. That means that the company is profitable, it's increasing its profits, and there is a high probability that for the next reporting period, the company will also show better than expected EPS data, which will positively result in its stock price. As you can see, EPS actual was higher than estimated, higher than estimated, higher than estimated, higher than estimated. That's a good sign, and we can expect higher EPS to the next reporting period. And this EPS estimate is lower than the previous estimate, so there is even better chance that the Google will show better number than analyst estimate, which can result in the Google share price going up on the earnings date. Of course, there is no guarantee that the Google price will go, like Alphabet price will skyrocket on the reporting date, but there is a high probability that it will go upwards since it was beating the estimates in the past, and since the last estimate is lower than the previous estimate, so Google has good chances of beating the estimates. Now we can use the DCF valuation. This is the DCF model. Again, I have a separate video on DCF valuation. I will place the link in the description to my YouTube video with this model. But this is the simple table. The formula is FMP Advanced DCF. Again, if you remember, we already used this Advanced DCF from here, but here we only took the WACC. In this case, we are taking the full Advanced DCF. As in here, I place FMP Advanced DCF and put the stock ticker. We should replace this docu with Google. And now you see the DCF calculated, extracted DCF, extracted with the financial modeling prep. This is very useful for calculating the stock target price. And this data is used in this model. As you can see, I have the formulas that are using these numbers from the inputs that we extracted using the financial modeling prep, FMP Advanced DCF formula. And these are all the data that we need, extrapolated, forecasted till the year 2029. That's how DCF works. You forecast the cash flow and then divide this cash flow by the discount rate or WACC rate, as some analysts call it, weighted average cost of capital, which is 8.95 in our case. As you can see, all the data here is extracted from these inputs provided by the financial modeling prep API endpoint. And then based on this calculation, the stock has 42% growth potential based on the DCF model, and you can also see the stock target price calculated. So the calculated stock price target price is 261.35 and the market price is 184, which implies the 42% growth potential based on DCF valuation model. So what we can do, we can copy this number 261. As you remember, it's from DCF. So the DCF gives us 261. Then price income model gave us 213. And consensus analyst target price was 201. And now we just can calculate the average. Just let's take a simple average. And we can say that the stock target price based on our DCF calculation with our assumptions, based on price income model with all the ratios that we took, individual ratios, and based on consensus analyst target price is equals to 225, which is, let's calculate the gross potential, 225 divided by 184, which implies the 20% gross potential for Alphabet share from the current level. So we've taken three different targets, consensus, based on price income and based on the DCF model, and the Google share has a 20% gross potential, which is an amazing result. Now let's go to the another website, Yahoo Finance. Just input the Google share here. And here what we can see, you see 5-year beta. That's what we need for our table. Here, remember I told you we will return back here. Beta is less than 1, almost equals to 1. That means that the stock moves in tandem with the market. And by saying market, I mean S&P 500. So they kind of move close to each other. Then the market capitalization, the size of the company, beta, Google is a large company, of course, 2 trillion market capitalization. We came here in order to go to the analyst here, analysis. And inside the analysis, we should go to EPS trends, and you can see how EPS estimates, how EPS expectations changed. These are estimates made by different investment analysts. And you can see 90 days ago it was 203, 7 days ago it was 201, 202, slightly declining, but still it's okay. But if you are analyzing some company, if you see huge drop in EPS trend, that's a bad sign. That means that analysts are turning negative and it can negatively result in the stock price. And there is a high probability that the company won't be able to beat the actual results because analysts are skeptical, they are changing their model. But if you see this is changing, the current estimate is higher than the 90 days ago, 60, 30 days ago, that's a good result. That means investment analysts are positive about the company's EPS and they're sure that EPS can beat the estimates. But in our case, they are more or less neutral, so to say. So this is how you can analyze the Google share. And now let me just go back and see 225. Now, based on fundamentals, we see that the Google is a strong company. You can also compare it to closest peers to see the WACC, ROIC ratio. Now let's go to the trading view and see the technical analysis for Google shares. For that, I'm going to the trading view, but you can use your trading terminal for that or any other website for seeing the chart and doing the technical analysis. I am opening the Google chart. But before we dive to technicals, let me show you one quick and very useful app for calculating the stock growth potential and for seeing if the stock is strong fundamentally or no, and also for defining the good entry point and understanding if you should sell the stock and when you should buy the stock on intraday, on the shorter term. The app is called stocks to buy. You can find it on App Store. It's exclusively on the App Store. Just log in and register, open the app, and then on the main screen, first you can input the stock ticker that we're looking for. In our case, it's the Alphabet share. And now you can see the stocks to buy app provides the buy recommendation for the Google share with the equity rating buy. That's the analyst recommendation buy. If more analysts are suggesting buy, then the equity rating is buy. Then the neutral stock sentiment and the good EPS surprise of 141, but it has all the chances of beating the next the EPS estimate on the next reporting date. So the app is showing the buy recommendation based on the midterm. Then we can go to the stock type and input the Google share and hit the analyze button. And here you can see the Piotrowski score of 8 that indicates that Google is very, very strong share. Actually, Piotrowski score, the maximum is 9, but I will send you the link down to this video and you can read what is the Piotrowski score and how to calculate it, but it tells that the company is very strong fundamentally. Now the app is saying that the gross potential is only 10.151%. You can read the description. It is also using the target prices of different analysts, but in this case it's taking the most recent calculations, so fresh data to calculate the gross potential. Dividend yield is not paying large dividend, 0.33, and you can see the gross dynamics in the past 6 and 3 months, meaning that the Google still has a great upside potential. Usually when the shares went up by 30, 40, 50%, they are kind of losing their limit to grow on the shorter term, but in case of Google, it grew only 2% in the last 3 months, so given the good fundamentals, it can still go upper. So we saw around 8% gross potential in the shorter term, and on the mid-term to long-term around 10% gross potential. So if you're holding this share within couple weeks or couple months, you can close the position as soon as it gains 10%. It has all the chances of gaining 10% on the shorter term. Now you can go to the candle analyst screen over here if you're trading this stock on the intraday. These candles update every 5 minutes, so hit refresh button. And as you can see, the stock is suggesting to buy because it's a bullish engulfing, meaning that the stock will go upwards. You see this forming. It's the candle analyst, this application, the stock to buy app analyzes Japanese candlestick patterns and then provides you with important patterns. This means that the stock may go up, and indeed it goes up after seeing this pattern. Then we have the doji star, meaning that this stock, the traders and the buyers and sellers are not decisive, and the stock can go in both directions. So if you see this, just wait, don't sell or don't buy. But these are strong signals, meaning that the stock will go up, and it already went up within the next 20 minutes. So these candles update every 5 minutes and provides their live prices. This screen is good for shorter term trades, intraday trades. If you like making many deals per day, buying and selling shares, this is your screen. And if you are more of a mid-term investor, this is your screen that suggests that Google is a strong company, and also it has a buy recommendation. So I hope this app will help you. It's called Stocks to Buy. I'll put the link down to this video and you can download it. Now let's proceed to the technical analysis of Google shares. And inside, first let me put the basic support and resistance level from here. As you can see, just very basic support and resistance. Again, I will put the link to the description of this video on how to draw this support and resistance, what they signify, like how you can predict the stock price target based on the shorter term time interval, and what instruments you can use. I will share this link to the description down to this video, and you will be able to read it. But for now, let's put those support and resistance level to see how stock is trading. As you can see, it's approaching its support level, and we saw fundamentally, based on fundamentals, the stock has 20% gross potential. I think it was 225. Yes, 225. Somewhere here. This is a long-term target. It's fundamental target for Google share, but now let's see the short term. Let's say you want to trade the Google share within a limited time frame for the shorter term time interval. In this case, you can just use very simple extension that is called Stock Analyzer. It works on the Chrome browser. Open the Chrome browser, download the Stock Analyzer extension. I will put the link to description down to the video. And here you just need to input your custom API key and then Google ticker. And you can see the stock. Don't pay attention to this. It's a stock target price calculated again with this extension, but we already calculated the stock target price and we know the consensus target price. Even here the stock is undervalued, but it is even more undervalued based on our calculations that we just made. So you see on the shorter term, within couple weeks, you can take profit at 200 and stop loss at 170. So let me put it down here, 170 and 200. So 170. Let me change the color. No, let me put some other color so that it is more distinct. And 200. That means that if you buy this share right now at the current price approximately, you still have 8% gross potential, 8.4% gross potential before you can close your position with profit. This extension is using the standard deviation stock volatility to calculate the stop loss take profit. And if you buy this share right now, you can wait a bit before closing your position at this level, but there is a higher probability that it will bounce back from here and go higher because fundamentally it looks strong. But still, if it goes here, you can close this position. Even don't wait this level, you can close it earlier because the previous support was somewhere here. So if you see the support level was higher than the stop loss, you can close position earlier. If stop loss would be higher somewhere here, for example, calculated by the Chrome Analyzer, Stock Analyzer Chrome extension, then you can close earlier. But in our case, the stop loss was lower somewhere here, lower than the next support level, and you can close somewhere when the stock not at the support level, but when it breaches the support level and goes to somewhere near 172, for example, that's where you can already close the share. So on the short term, it has around 8% gross potential. On the longer term, around 20% gross potential based on the analyst consensus target price, DCF valuation model, and the price income valuation model. And also Google share looks very strong, but I would diversify my portfolio. I would never put one single share, just put the stock from different industries. Always trade shares that you understand and be able to forecast, and you should have the feeling of the stock. Just don't rush into trading. Observe the stock, how it behaves, and until the point where you feel the stock, and regularly undertake the fundamental analysis that we just did in this video. I hope this video was very helpful to you. Thank you very much for watching. Have a wonderful day.